Hello, everyone. So my topic is about retained earnings. So for the retained earnings, actually this is the income, no? Income accumulated by the company over the years. Yan yung retained earnings. Now, there are two major sources of capital for every type of business. One is the capital from investment by the owners, so meaning it came from the pocket, no, from the owners, and then invested to the company. And then the second one is the capital from earnings retained in the business. So meaning a portion of the net income was retained or reinvested to the company. And then of course, a portion of that net income was distributed as dividends or withdrawal by the owners. But the portion retained or invested to the company is your retained earnings. So entered in the retained earnings account, in that portion ng net income. Then only a portion is distributed to stockholders, so meaning that is the dividends. And the balance is retained to help finance growth of the business. Now, there are very few transactions affect the retained earnings account. Usually, the only credit for the net income, the net income is normally credited, of course, for the retained earnings. But if it is a net loss, the retained earnings is debited. And then, of course, the retained earnings also is debited for the dividend payments. And then, if you are going to appropriate a portion of the retained earnings. So when we say appropriate, you will be using the retained earnings to purchase something or maybe for expansion, purchase capital assets, or to maybe expand your business. No? So you're closing a portion or appropriating a portion of the retained earnings. Now, the closing entries for corporations to retained earnings will be as follows. So if it is a net income, you debit the income summary, and then you credit the retained earnings. So meaning, your retained earnings here will increase by this amount. Okay? And then if it is a net loss, then the retained earnings will be debited and the credit will be the income summary. So meaning the retained earnings will be reduced by this amount. Now, closing the income summary and dividends accounts to retained earnings. So we have the income summary. So let's see, we have the net income close to already to income summary. So if you will transfer that to the retained earnings, then you debit the income summary and then credit the retained earnings. And then once you pay for dividends naman to the stockholders, then you debit the retained earnings and then of course credit the dividends. Okay? So cash dividends. So this is the distribution of earnings to stockholders that is in the form of cash. So can be issued if corporation has unrestricted retained earnings, so meaning a portion of the retained earnings is not available, no? A portion of the retained earnings is already available. That's why it is unrestricted, because it is possible that you have retained earnings, but all of them are restricted. But in this case, the dividends can be appropriated if there are unrestricted retained earnings. Then it has an adequate cash balance, and then can declare the cash dividend. No? Can be declared only by the board of directors. So maybe upon the request of the stockholders, but primarily the one to declare the dividends will be the board of directors. So we have the dividend dates. No? For the dividend dates, it is important that we have the date of declaration. This one. Then we have the date of record, and then the date of payment. So, for example, we have on February 1, the board of directors declares a dividend of $2 a share on common stock. So that is the date of declaration, February 1. And then payable on February 20 to stockholders of record on February 10. So this one is the date of payment, and this one is the date of record. So meaning those stockholders still holding on the stocks on this date. Okay, date of record. So example tayo, On February 1, the Board of Directors declares a dividend of $4 per share on 4,000 shares of preferred stock and a dividend of $2 per share on 10,000 shares of common stock. So both dividends are payable on February 20 to stockholders of record on February 10. So the journal entries will be as follows. No? So upon declaration, we have the debit cash dividends, then credit preferred dividends payable. So the 16,000 were computed using the 4,000 shares of preferred stock and $4 per share for the dividend. So that's why it is 16,000. And then for the common stock, we debit the cash dividends, then credit common dividends payable. So this is where's the dividends here? This one. No, and a dividend of $2 per share on 10,000 shares of common stock. So 2 times 10, so you have that 20,000. So again, we debit the cash dividends and then the dividends payable. So we have the preferred dividends payable for the preferred stock, and then the credit common dividends payable for the common stock. And then on the date of payment, the entry will be preferred dividends payable, then credit cash. And then for the common dividends payable, we debit common dividends payable, then credit cash. So this one, ano? So i-debit natin pagka nagbayad na tayo. Okay? Then, assuming the only dividends paid during the year were the one just described, so ibig sabihin, ito lang yung dineclare natin dividends, let's see, for the year. So at the end of the year, no, we will close that cash dividends to retained earnings. So we debit retained earnings, then credit cash dividends, no, for the total. So we have the 16,000, 20,000 in total natin, di ba? But what we are closing is this particular account. Cash dividends, cash dividends. Yan ang na-close natin na account at the end. Okay? So ito ang close natin against the retained earnings. Ayan. Debit kanina. So this time it is what? Credited to cash dividends, and the debit is retained earnings. But it is also possible, no, that instead of debiting the cash dividends here, no, it is also possible that we can use immediately the retained earnings. Pwede rin yun, no? Pwede rin natin gamitin yung retained earnings. Okay, kaya lang doon sa book ni Hints and Parry, so they first debited the cash dividends, and then later on, at the end of the year, they will charge it to retained earnings. But again, it is possible that instead of using the cash dividends here as debit, we can use the retained earnings. Now, the effect of cash dividend. So before the dividend, we have the paid-in capital of 100,000 and then retained earnings 350,000 for a total of 450,000. So once you declare dividends, the retained earnings will be reduced, no? So for the amount of the dividend. So in this case, we have 350,000. We have the dividends declared na amounting to 36,000 for common stock and preferred stock. So we will deduct that from the retained earnings. So the reason why now it is 314,000, no, after the dividend. So the paid-in capital is not touched, no, but only the retained earnings. Particularly the retained earnings are not appropriated. So again, the retained earnings is reduced by the amount of the dividends. So a proportionate distribution of shares of a corporation's own stock to its stockholders. So that is the stock dividend. So instead of, let's say, paying cash dividends or declaring cash dividends, this time they will declare stock dividends. So yun nga, the stock dividends, it is a proportionate distribution of shares of a corporation's own stock to its stockholders. So several reasons for this type of dividend. We have a company may be short of cash. So it may be a company may be short of cash. then company may want to increase marketability of the shares, lowering price per share, and corporation may want to transfer a portion of retained earnings to a paid-in capital to indicate that it is unavailable for dividends. Typically, stated as a percentage of common stock outstanding, date of declaration, journal entry varies depending on the dividend percentage. So stock dividends for less than 20 to 25% of outstanding shares, small, and stock dividends is debited for the market value of the stock. So if the stock dividends is less than 20 to 25%, then the stock dividends is debited for the market value. But if it is large, then it has to be what? Debited for the par value or stated value of the stock. So I'm going to stop here first class, okay?